Story credit. Sorry for being a bit slow and getting back to you here. Right, so I just want to show you a few charts here, basically, um, just to give you an idea of what it is that I've been looking at in terms of trying to gauge, um, basically, when this end of world collapse is going to come, and why basically most of the indicators that I've been looking at are suggesting that we're there. Um, so basically, just having done a good bit of high level macroeconomics sort of study over the last few years, and really I sort of got into like cryptocurrency. And during the last bull run, kind of ended in 2017, I started just getting more and more into learning about trading and analysis and things like this. And there was this one fella who I just saw was consistently brilliant. One particular trader, but he kind of offered the odd YouTube video he would show you, but he had a kind of subscription service where you pay him like a couple of £100 a month, um, and he'd kind of take you through a lot of different trading analysis models and things like this. But also he would show you the main things that he was looking for in terms of interim little targets and different plays that he was making, but more broadly, basically for this major market crash. And this is coming from about 2 years ago. And I stopped about 6 months ago. It's just freaking dear as anything, paying £200 a month for this. But basically, I felt at that point I'd learned everything that I was needing to learn from him. But basically, in a nutshell, and that's why you can see how everything that's happened over this last year. You become increasingly skeptical about it, because when basically people like this are telling you way in advance that we're going to be experiencing all sorts of QE and all sorts of stimulus in order to kind of which will ultimately lead to euphoria in markets, and then you're kind of just sitting going like, but how can that happen? Like, what sort of possible justification can make that come into the world to make that happen? And then you get the whole Corona thing. I mean, that's when you become skeptical about these kind of issues in general, because you kind of know in advance that something's going to make this happen. Oh, look, here it is. It's too like I think in general, the more I find, the more that I learn about economics and kind of things like this, the more you become questionable about fucking so many things in society, because you can kind of like see things happening slightly ahead of time, and then just happenstance, these things happen, and create these supposed justifications for the need for central banks to step in, or the need for governments to step in, and the kind of show just unfolds as it was kind of meant to. But anyway, so this is the Dow Jones, first of all. Just even graphically looking at this, it should be alarm bells for people, because if you can see here at the bottom, this is like 1999, 2000. So this was dot-com bubble peak and full recession. At the time, you can make it by filtering it look a bit more aggressive then. So, that was running throughout the 90s, the Dow Jones, to its peak in like January 2000, and then a few year recession there. Here's October 2002, and then we had our run up to what they call the GFC, the Great Financial Crisis, 2007, 8, 9. We got up to Dow Jones got up to a high of like 14,000 here, and then tanked down to 6,500. So that was basically a fall of like 50%. And most markets around the world kind of reflected that. But basically, the best fellas that I've followed and learned from, and start to kind of learn it myself now, over the last few years, basically just think that what's coming is going to make these recessions look tiny in terms of like the impact in society of the depression that's probably going to come here. But basically, the target that he was basically talking about whenever I started listening to him in like 2017, early 2018 probably, was 40,000. And although we're at like 34,000 now, it's kind of like euphoria is at its greatest typically right before the collapse. So I don't even know how, this could be surprisingly just even a matter of weeks before the Dow gets to that territory, assuming that he's correct. But we're basically in that real rocky territory anyway. But the interesting thing, and he mentioned this could happen as well, was he had on the Nasdaq, so that was the Dow Jones, but on the Nasdaq he had said that it could top earlier than the Dow. So it's not necessarily, it would be quite simplistic if all these things could just kind of go simultaneously to the top and then all fall at the same time. It would be quite easy to navigate then. Unfortunately, apparently it doesn't necessarily work like that. But he basically thinks that the Nasdaq's going to start to crater before the Dow tops, and his kind of target for the Nasdaq all this time has been 14,000. And there are a lot of different kind of trading models, mainly a thing called Elliott wave theory that he was using in order to sort of calculate these targets. But in a nutshell, he's basically explaining how, if I'm able to identify these targets, the fellas in JP Morgan, the fellas in Wall Street, and all around the world will have these same targets, and it's almost like part of the game, effectively, where that's just, these are like the known territories to buy and sell or whatever. But so basically 14,000 approximately was his target. I think it was 14,400 or something was his target for where the Nasdaq was going to go, and it's actually just breached 14,000 there. So I have this filtered for weeks. So each of these little green candles and red candles represents 1 week. Green means it finished up on the previous week. Red means it finished down in the previous week. But so we're slightly down on last week's peak of just over 1,400 or 14,000, but could potentially tip up a wee bit higher over these next couple of weeks. But then the kind of inverse that he was looking at, and he's been looking at just kind of like as a legacy thing for himself almost, was to basically short the Nasdaq. So this thing here called SQQQ, basically it's an inverse ETF of the Nasdaq. You can see how much it's fallen over the last few years. It's not quite as simple as a normal share or ETF in the sense that it's got this thing, these inverse ETFs, which are in effect shorting. They have this thing built into them called decay, which means that it basically will always go down in time. So it's not, they say that you can't really like hold these things long term, because even if you make the rally that goes upwards, like here for example, it went from 80 to like doubled basically. That's in March 2020, whenever all the markets fell. This inverse ETF did well. Inverse ETF of the Nasdaq, but yeah, basically you can't just sit and hold this long term, because it'll always go down, even if the Nasdaq kind of goes sideways. But anyway, his buy zone for like, which he was talking about a long time ago, and like people were laughing at him for saying it would even get to here type thing. His buy zone was basically in the territory of if it got anywhere near 10, you'd be laughing to be starting to accumulate it, he was saying. So we got as low there, literally, now each of these candles represents a day in this chart, as opposed to a week in the last couple. But a few days ago there, it got as low as 10.5, then it got back up to just over 11, and as of today we're back down to about 10.8 or so. But what I'm basically getting at here is, to the best of my knowledge, very sophisticated traders have targets which are basically in and around being hit right now for their perceived top of the Nasdaq, their perceived low of the purchase of. So SQQ, basically SQ, I think there's an SQ ETF, which is basically just a straight short of the Nasdaq. SQQ is like a 2x leveraged short, and this is SQQQ, which he was looking at. So it's like a triple leverage short, basically meaning that if the Nasdaq goes down by 10% and you're holding this, you're going to get a 30% gain. So it's just 3 times the risk exposure, 3 times the potential reward. If the Nasdaq, in theory, if you were holding this, went up by 10%, you'd be losing 30%. But this is what he's been looking at. So it's not to say that necessarily it's just going to go bang from here, but somewhere over these next couple of weeks, I imagine, assuming he's correct, and I have no reason to suspect it's not correct. When you consider all the things that are going on at the moment with what I'm trying to like figure out how this all fits together. Basically, we're due to open up now. Things are due to open up. So maybe something with that is just, but the other things, we're due to open up, but at the same time, there's people obviously coming out saying that there's going to be lockdowns now for another year, for another 2 years, and all that sort of madness. So something in that could potentially, act as the trigger for if some sort of big nation suggests that that's what they're going to do, could just completely crater an economy. There'll be some sort of like trigger, but like that's all it is a trigger. It's like this knowledge by these insidious bastards is already there. I'm imagining this is the Dixie, it's called. So it's like basically the dollar index against the basket of different currencies around the world. But basically, it just represents the strength of the dollar, which has fallen basically throughout the last year quite a lot. I'm imagining the dollar's going to strengthen, and I think that's what he was kind of suggesting as well from this point here potentially. If it strengthens in all other against most other major currencies, that would happen probably coinciding with, if the dollar strengthens, most other markets that are denominated in dollars will probably take a hit. So in a funny way, I actually think that short term, because there's different stocks that I'm looking at. So there's this one that I'm basically all my money's in. It's called Biggs Financial Cloud. It's a Scottish-based firm. Basically, I'm seeing this going a lot higher, just based on different trading analysis, and just think the company's undervalued in general. Similarly, this one called VR Holdings. It's a company based in Waterford, actually. Virtual reality kind of platform it has, but again, I think it's massively undervalued and think it's gearing up for a move much, much, much higher. But potentially this sort of scenario could happen when, say there is a massive increase in the strength of dollar, and then, say if sterling and euro took a bit of a hit short term, that would actually allow, it's strange, the stronger a currency is, it actually hampers a market's ability to perform well. Typically, if a currency is weakening, there's less value to each of those currency units, so it can kind of free up these potentially domestic shares, the home performing better. But yeah, it's a strange one. Strange trying to see how it all ties in together. But I think that's giving you a rough idea. I was just trying to think if there's anything else obvious or that I'm missing. Not necessarily, but yeah, I have a lot of confidence in particular in this one called VR Education. Basically, it got up there last year, March 2020 lows of like 4.5, basically got as high as 25 in just a couple of months, and it spent the last year basically having a major correction down to about 10, 11 territory, and we're still not far off that. And basically, the more there's a move towards lockdowns and things like this, and necessity for remote work, virtual learning and things like this, and interaction, these guys are ahead of the game basically in terms of the platforms and the things that they have to offer. They've been basically working away at a real, high level on things that bigger firms like Facebook and all have just been sleeping on basically, and are only catching up now. But they've made big partnerships with HTC, major Taiwanese telecommunications company, and I think even they're on the different kind of like Facebook headset platforms and things like that now. And basically the company's only worth at this share price something like 12, 13 million or something like that. But they were valued at basically double that almost a year ago, and yet they're kind of like their demand's increasing all the time now with all the madness that's going on. And if there is a scenario where they try and suggest further lockdowns or further need for remote work or something, that the company, I guess, will probably just go through the roof. But I don't know, it'll be interesting to see how it all kind of like pans out. But yeah, there might be a wee bit more euphoria over the next couple of weeks in general, as it kind of sucks in more people to the markets, and probably news and things like that will probably encourage people to be more buoyant about the future of the economy and stuff like that, just at the worst possible time to get involved. And then I think everything else will crater. So in general, I think that like, if I just wouldn't want to be sitting in any like large scale funds or anything at the moment, that have just shares in normal companies. If you're taking a chance in kind of smaller companies that you think you have a bit more of an edge in and have reason to think they're going to do well, there probably still is opportunity there. But for the most part, I think we're entering very choppy waters. Anyway, hope that I guess a shout, sure, if any questions or want to chat or whatever. Anyway, all the best. God bless.